Kia ora, and welcome to the CoreLogic Property Market Update for Haratua 2022. If there was any doubt about the property market being in a downturn, there can't be any more. Across Aotearoa, sales volumes are 32% down on the same time last year and 20% down on the long-term average for this time of the year. A sign of the misalignment between vendor and buyer expectations that has materialised over recent months. Tightened credit availability and affordability pressures continue to impact the number of active buyers in the market, while those who have secured finance are feeling more empowered to negotiate as properties remain on the market for longer and sell for less than what would have been achieved 6 to 9 months ago. Weakness in property values is evident right across the country, with some of the largest cities experiencing the biggest falls so far. The CoreLogic House Price Index for Auckland and Wellington showed declines of 1.6% and 1.5% respectively over April, while quarterly value falls in Wellington of 2% and Dunedin of 2.9% were the largest for these cities since the global financial crisis. It's worth noting that some measures, such as the Rhines HPI, have recorded even larger falls of more than 12% for Auckland City and Wellington City since the recent market peak in October-November last year. Our main urban areas have been unable to escape the recent weakness either. In particular, many areas in the bottom half of the North Island have experienced falls of at least 0.5% over April. Lower Hutt, Upper Hutt and Wanganui dropped more than 2% over the month, as did Hastings and the Hawke's Bay. These are all areas which saw exceptional growth through the latest upswing, often supported by strong first-home buyer activity. Activity which has been significantly impacted by the reduced availability of credit. The biannual CoreLogic First Home Buyer Report, released earlier this month, outlined this reduction in activity in detail. Just 22.5% of sales in the first 3 months of the year went to first home buyers, down from 26% in the second half of 2021. The median price paid by first time purchasers was over $750,000, which meant a typical mortgage of $600,000. This is a significant sum of money to be borrowing, especially with increasing interest rates amongst other rising costs of living. Mortgage investor activity is also relatively constrained, as the sheer weight of increased regulation limits the appeal and potential profit of property investment. Loan-to-valuation restrictions requiring a 40% deposit, the elimination of interest cost deductibility, healthy home standards, high serviceability test rates, and now the absence of capital growth will have many investors and their accountants questioning the timing of buying investment property. This environment of the higher cost of everything has also translated through to rents. And while we expect the annual growth rate in rents to be anchored by income growth and drift back towards the long-term average of 3%, the persistently high growth rate in recent times can't simply be attributed to catch up from the rental freeze in 2020 anymore. Looking ahead, many of the private sector house price forecasts are becoming grimmer by the week. And it's worth looking beyond the headline percentage figures too. Not only are the likes of Westpac expecting a 15% fall in values from peak to trough, but the road to recovery also looks very long, with housing values forecast to remain below the recent peak for at least another 4 years. That is assuming all remains equal, so is contingent on the same strict lending environment persisting, which remains highly uncertain. While we know the Credit Contracts and Consumer Finance Act changes are to be eased to allow more lending, the impact of increasing interest rates, including serviceability test rates, may limit any rebound in demand. Meanwhile, the Reserve Bank has pushed any consideration of introducing official debt-to-income limits for now, but they still do remain a possibility in the future. The economy remains a key focus then, with varying unknowns percolating. Many of them probably balancing to the net negative side of the equation. The full opening of the border seems likely to lead to less demand for property. Inflation pressures remain, which will see further increases to the OCR. And the construction industry is near capacity and dealing with heightened costs itself. The main saviour for a controlled downturn is low unemployment. This means a lot of focus on the labour market, which appears to be holding up for now. Ultimately, no one is predicting disaster from these factors, but they will all influence how the market plays out over the next few years. In the short term, keep an eye on listings volumes. And remember, while we're well above the levels of the last couple of years, this is not due to a rise in people listing their homes. It's simply a reflection of slowing sales and properties staying on the market longer. Make sure you don't miss a beat in this ever-changing environment by subscribing to our weekly property market podcast and regularly check in with the research news at corelogic.co.nz for all our reports and articles regarding the Aotearoa property market. Kia noho haumaru, mā te wā.